It's great to have you both here. And Jay, you're watching crude prices, or I should probably say pump prices, aren't you?
Oh, yeah, for sure, Kelly. Pump prices we've seen gasoline prices rise, 30 cents or so, 40 cents or so, over the last month or so. So all those things could, push the overall headline rate of inflation a little bit higher. I mean, I think what's more important is the core rate of inflation, and that's coming down. But that still remains, depending on what measure you're looking at, 3.5% to 4%. So inflation at this point certainly remains elevated.
And so when we say elevated, I guess the real question, goes a couple of ways. Number one, okay, are we going to go from 3.2 on the CPI to 4, or are we talking about a bigger upward risk? And does that, if the Fed is now expected more or less to not hike rates again, might they get involved? And I guess the way I look at it is all of this, a drag on the consumer, a tax on the consumer, really? How should we be analyzing this as signs of more inflation in the economy, or is ultimately something that could drag on growth and on the consumer?
Well, right now, in terms of the consumer, in terms of real purchasing power, wages and salaries are rising faster than most measures of inflation right now. So that's good for consumer spending going forward. I think the area where you have a little bit more concern is, the Fed's probably not going to be cutting rates anytime soon. And if core inflation continues to drift lower coming forward, which we think it will, then you're going to have the real interest rate, the real Fed funds rate, actually start to move even higher. You're going to get a passive tightening of monetary policy going forward. And so that's what really matters for real economic growth at the end of the day, is the real Fed funds rate. And so that's something that we're keeping a very close eye on, what's happening to the real Fed funds rate and how much headwinds on the economy that can exert.
All right, fair enough, and I'll circle back to that. But first, John, I want to ask you if you're worried about inflation turning back up, or what you think prospects for the market look like in what's been a pretty choppy month. And like Mike said, we've had the hottest part, the NASDAQ 100, now down, 6, 7, even 8% at the lows from the highs.
No, you're right, Kelly. I mean, technically, the S&P 500 hit its recent high, I should say, on July 31st. We are concerned about inflation. We're concerned about two of the things that Jay talked about. Price of oil, it's a high of the year. Now, our equity team likes it because they're overweight energy. But then we're also concerned restrictive monetary policy going into next year. So stocks may stay choppy here the rest of the year, depending on what the Fed does.
And why is that? I mean, what do you think is kind of the choppiness proxy? More, inflation, more Fed chatter, that kind of thing?
Well, technically, our equity team we're not seeing any earnings per share estimates go higher now. We're seeing beats, but we're not seeing raises. And that's one of the things on our mind, given the high PE multiples of some stocks and some indexes overall. So that's why we say the market could chop from here, mostly around earnings, then not what the Fed does probably in September, but potentially what they do in November if they go in their every other meeting rate hike cycle.
And what's your favorite part of the market right now? Are you investing in energy? I mean, is there anything that, you just T-bill and chill, or what do you think?
No, we've gone a little bit of a bias towards bonds. We took basically some success out of stocks in mid-July because they'd run up so much first half of the year. Turns out so far that was the right thing to do. And then allow our clients to enjoy higher yields. But within the stock market, energy is one area we're looking at. Financials is the other area. Higher interest rates are generally good for them. We're seeing activity there. So financials and energy are two areas of interest to us on our equity team.
Right.